Okay, so when you try to picture the used car industry, you probably have a very specific image in your head.
Oh, I definitely know the one. The wacky inflatable tube man flailing around in the wind.
Exactly. That, or maybe the smell of stale coffee in a waiting room while someone goes to talk to their manager for 45 minutes about floor mats.
Yeah, those are the classics.
Right. You generally do not think of a high-tech powerhouse posting nearly $2 billion in net income.
No, those two concepts definitely do not match up in most people's minds.
But that is exactly what we are looking at today. We are doing a deep dive into the Carvana fourth quarter and full year 2025 financial results.
Which just came out.
Right, they just dropped these numbers on February 18th, 2026. And I have to be honest with you, I opened the press release expecting the usual tech story of we are growing, but we're burning a mountain of cash.
Which was their story for a long time.
It was, but instead I saw numbers that, well, they kind of broke my brain a little bit.
It is a staggering report. And what makes it so fascinating to dig into isn't just the sheer size of the numbers, though. Believe me, we're going to get to those. It's what they tell us about how the entire automotive landscape is just fundamentally shifting. We've combed through the shareholder letter, the really dense financial tables, the CEO's commentary, all of it, to figure out one main thing. Is this real?
Right. That is the mission today for you listening, because we have all seen corporate hype before. We need to figure out how a company goes from being on the brink, because you might remember a few years ago when everyone thought they were going under.
Oh, yeah. Bankruptcy rumors were everywhere.
Exactly. How do they go from that to posting record-breaking profits? We need to look at the mechanics, the operations, and yes, the accounting tricks that might be hiding in the footnotes.
We absolutely need to look under the hood. Because while the headline shouts $2 billion in profit, the path to actually get there involves some really complex tax assets, some stock warrants, and a complete change in how they move metal across the country.
So let's start with the big picture, the year in review for 2025. I am looking at the top-line revenue right here. For the full year, Carvana hit a record $20.3 billion in revenue.
$20 billion. Just pause and think about that for a second.
It's a whole lot of zeros.
It is. And what is critical here isn't just the flat number, it's the growth rate. That $20 billion represents a 49% increase year over year.
Almost 50%.
Right. Usually when companies get this big, when they hit that true Fortune 500 scale, growth starts to taper off pretty hard. You expect maybe 5%, 10% growth if they're doing well. To be growing at nearly 50% at that massive scale is just, it's aggressive.
And it is not just inflation or, temporarily higher car prices driving that revenue up, right? They're actually moving significantly more cars.
Correct. They sold 596,641 retail units in 2025.
So basically 600,000.
Yes, almost 600,000 cars actually delivered to driveways. Yeah. And that physical volume is up 43% from the previous year.
Okay, so they're selling a ton of cars. But here is where my skepticism kicks in. Because we saw this exact movie before in the tech world during the zero interest rate days. You can sell dollar bills for 90 cents and generate infinite revenue.
Oh, absolutely.
Right. You can grow 50% every single year if you literally do not care about losing money. So is that what is happening here?
That is the pivotal question for anyone looking at this company. And according to this 2025 report, the answer is a definitive no. This was not profitless prosperity.
Okay.
In fact, Ernie Garcia, the CEO, made a really bold claim in the shareholder letter. He pointed out that achieving this level of massive growth, while simultaneously hitting record unit economics and providing better customer value, doing all of that at once is, quote, rare.
Rare seems like a bit of a humble brag. I mean, in business school, they teach you the iron triangle: fast, good, cheap, you get to pick two. He is basically claiming they figured out how to pick all three.
Effectively, yes.
Yes.
And to understand how they manage that, we have to talk about something they refer to as the positive feedback loop.
Which sounds like corporate buzzword soup.
It completely sounds like buzzword soup.
Yeah.
But it is actually a very grounded logistical argument.
Okay, break that down for me. Because how does selling more cars make the cars cheaper to sell? Usually, scaling up adds complexity and cost.
Think about the physical reality of Carvana's business.
Yeah.
They aren't just a website where you click a button. They are a massive logistics network. They have those big multi-car haulers, inspection centers, the giant glass vending machines.
Right.
When they were smaller, say 5 years ago, a car might have to travel 500 miles on a truck to get to a buyer. That costs a ton in gas, driver time, wear and tear.
Sure, shipping a heavy vehicle is inherently expensive.
Exactly. But now, because they are selling nearly 600,000 cars a year, and they just crossed 5 million cumulative customer transactions overall, they have way more inventory sitting much closer to more customers.
Ah, I see.
The average distance any given car has to travel drops significantly, and when the distance drops, the shipping cost drops with it.
So the unit economics, meaning the actual profit they make on each specific car, goes up simply because they aren't spending as much money dragging it across 3 state lines.
Precisely. And it actually goes even deeper than that. This connects back to their vertical integration strategy. Do you remember a couple of years ago when they bought ADESA?
The physical auction company. Yeah, I remember covering that. It seemed like a really weird pivot at the time.
No.
Why does an internet-first retailer need to buy a physical, old-school auction house?
It wasn't about the auctions at all. It was about the real estate. ADESA gave them 56 massive, industrially zoned sites all over North America.
Oh, wow.
In this 2025 report, they talk heavily about integrated reconditioning. Because they own all those physical sites now, they can fix up and clean the cars much closer to where they buy them and closer to where they eventually sell them.
So instead of shipping a beat-up Honda Civic from Chicago to some centralized reconditioning center in Texas and then shipping it back to a buyer in Ohio.
They just move it across town to the local ADESA site, recondition it there, and sell it locally. That speed reduces depreciation because remember, used cars lose value every single day. They just sit on a lot, and it brutally cuts down those transport costs.
That makes total sense.
That is how you get that record unit economics while still growing. The bigger the machine gets, the more efficient the machine becomes.
Okay, operationally I get it. But let's look at the actual profit numbers now, because this is the part where my jaw physically hit the floor reading the release. For the full year 2025, they posted a net income of $1.9 billion.
It is a massive swing. That's up more than $1 billion compared to the previous year.
And their adjusted EBITDA, which I know the finance types love because it ignores some of the noisy accounting stuff that hit $2.2 billion, up $850 million year over year.
It suggests that the core business, the actual lemonade stand, if you will, is generating very significant real cash. They aren't just borrowing money to keep the lights on anymore.
But wait, I want to zoom in on the end of the year specifically, because sometimes you see a company have a great Q1 and Q2, and then they just run out of steam. I am looking at the fourth quarter numbers here. Did they tap the brakes at all?
Quite the opposite. They pretty much slammed on the accelerator.
Really?
Yeah, in Q4 alone, revenue was $5.6 billion, which was up 58%, and retail units sold in those 3 months were up 43%.
Wow.
But here is the specific number that I really want you to look at. Look at the net income margin for the fourth quarter.
Let me check the table. Okay, net income margin was 17.0%.
17%.
Okay, hold on. 17% net margin.
Mm,
For a retailer, I mean, grocery stores make what, maybe 2% margin?
if they're lucky.
Right. Walmart makes like 3 or 4%. Even Apple, which is arguably the best consumer business in history, their margins fluctuate. But for a used car dealer to hit a 17% net margin, that sounds impossible.
It sounds impossible because, historically speaking, it has been. Traditional local dealerships operate on razor-thin margins for the actual metal, the car itself. They make all their real money on the back end with financing, warranties, and the service department.
So for Carvana to post a 17% net margin implies something else entirely is going on.
Exactly.
Okay, so what is it? Is there some accounting magic happening here? Because if they are actually making 17 cents of pure profit on every single dollar of revenue, they are one of the most profitable businesses on earth.
Well, put your skepticism hat back on because you are very right to be suspicious here. This is exactly where we have to peel back the onion on that press release. That $1.9 billion in net profit for the year. It was not all from selling cars.
Uh-huh. I knew it. So where did the money actually come from?
A very significant chunk of it came straight from the accountants, specifically from a line item called a release of a valuation allowance against deferred tax assets.
Okay. Release of a valuation allowance against deferred tax assets. That is a brutal mouthful of jargon. Please translate that into human speak for me and the listener.
It's actually a really interesting business story once you decode it. Think of it this way. For years and years, Carvana lost money. They were burning billions in cash to build all those vending machines and buy all those delivery trucks.
Right.
Now, when a company loses money, the IRS gives them something called a net operating loss. It is basically a tax coupon. It says, hey, since you lost so much money this year, you can use these losses to avoid paying taxes in the future if you ever actually manage to make a profit.
Okay, so they essentially have a giant stack of tax-free coupons sitting in a drawer.
Exactly. Millions and millions in coupons. But corporate accounting rules are very strict. If your business looks super shaky, if it looks to the auditors like you might just never make a profit, the accountants make you put a valuation allowance on those coupons.
Meaning what?
Basically, they make you officially declare on your books, these coupons are worthless because we will probably go bust before we ever get the chance to use them.
Oh, I get it. It is like having a $100 gift card to a store that is actively going out of business. You really can't count that as a reliable asset in your net worth.
Precisely. You have to
It's
mark it down to zero. But because 2025 was such an incredibly strong year for them, and because their future outlook is now so positive, the accountants looked at the books this quarter and said, you know what? You guys are actually highly profitable now. You are going to survive. You will absolutely use these tax coupons.
So they released
They unlocked the vault.
yeah.
They took that value, which was about $685 million worth, and they moved it right onto the income statement as a massive benefit.
Let me get this straight. So nearly $700 million of that headline profit was basically just a one-time accounting adjustment saying, congratulations, you aren't going bankrupt anymore.
Yes, it is what they call a non-cash benefit. It makes the bottom line net income look completely huge at $1.9 billion, but they didn't actually receive a physical check for $685 million in 2025. They just recognized the immense value of saving on their future taxes.
That is a really massive distinction to make. So if I'm an investor or if you're just someone trying to understand how healthy the actual business is, you should probably mentally subtract that tax benefit to see how the car selling part is doing.
You should absolutely be aware of it, yes, because it heavily distorts that headline 17% margin number we talked about. But wait, there is even more noise in the math. There was also a warrant liability.
Oh, right, the root insurance thing.
Yes. So Carvana has a deep partnership with Root, the insurance tech company, to build auto insurance directly into the online car buying flow. And as part of that deal, Carvana holds warrants, which are basically options to buy Root stock.
And stock prices go up and down.
Exactly. And the accounting rules say you have to constantly mark that stock value to whatever the market price is. In 2025, the fluctuation in those Root warrants actually cost them about $64 million on paper. It was a headwind.
So the giant tax coupon thing pushed their paper profits way up, and the insurance stock market thing pulled them down a little bit.
Correct. It is just a lot of accounting noise masking the daily operations.
Okay, so let's strip all of that away entirely. I want to ignore the tax coupons. I want to ignore the stock market gambling with Root. If we just look at the core business, buying a used car, cleaning it up, and selling it to a consumer, did they actually make money?
That is the ultimate test of the company. And for that, we look at GAAP operating income. This specific line item largely ignores the tax nuances and the investment fluctuations. For the full year 2025, their GAAP operating income was $1.88 billion.
$1.88 billion. So even without the fancy accounting tricks, they still made almost $2 billion in pure operating profit.
Yes. And the margin on the true operating margin was 9.3%.
Okay, that is extremely impressive. A 9% operating margin in retail, let alone automotive retail, is incredibly healthy.
It really is. It fully validates their model. It proves that the unit economics, that critical gap between what they pay you for your old car and what they sell it to me for, minus all their expenses, is positive. And it's growing. The business just works.
That feels like the real mic drop moment for them. Because for years, the vocal critics said, oh, they only grow fast because they artificially lower prices and lose money on every sale. This report basically screams, no, we grew 50% and we made nearly $2 billion doing it.
It is a very, very hard argument for the short sellers to counter at this point.
So where do they go from here? They have clearly proven the model works at scale. What is the actual game plan for 2026?
Well, according to the official Outlook section of the release, they are not slowing down to catch their breath. They stated they expect significant growth in both retail units and adjusted EBITDA for 2026.
Usually, Q1 is the slow season for selling cars, isn't it? I mean, everyone just spent all their cash on holiday gifts. It is cold outside. Nobody really wants to go stand in a dealership parking lot, or I guess in this case, nobody wants to spend big money browsing an app.
Historically, yes, the entire auto industry dips in the first quarter. But Carvana is officially guiding for a sequential increase. They are publicly stating they think they will sell more cars in Q1 of 2026 than they just did in that record-breaking Q4 of 2025.
That is extremely bold. They are trying to fight normal market seasonality with sheer momentum.
And if they manage to hit that Q1 target, it sets them up for a truly massive 2026.
Huh.
But honestly, the part of the report that really caught my eye wasn't the 2026 guidance. It was the long-term vision. The CEO laid out what they're calling their long-term financial model.
Oh, I saw this part, the big, hairy, audacious goal.
Yes, they are formally targeting annual sales of 3 million retail units.
3 million. Okay, let's put some context on that for the listener. They literally just sold roughly 600,000 cars this year. So they're publicly stating they want to grow 5 times larger from where they are right now.
Yes, 5 times their current record size. To put that 3 million number in perspective, there are roughly 40 million used cars sold in the U.S. every single year total. If Carvana sells 3 million, they would single-handedly control about 7 to 8% of the entire American used car market.
That sounds small when you say 7%, but in the auto industry, isn't that unprecedented?
It is practically unheard of. The used car market is famously incredibly fragmented. You have thousands of mom-and-pop independent dealers, you have the used lots at franchise dealerships, and you have private peer-to-peer sellers. No single corporate entity has ever really come close to controlling nearly 10% of the market. It would make them the undisputed Goliath.
And they genuinely think they can hit that volume while maintaining these high margins. Usually you have to discount heavily to move that much metal.
They're targeting a 13.5% adjusted EBITDA margin at that 3 million scale.
13.5%. They just hit 11% this year, which we already established was a record.
Yeah.
So they want to get 5 times bigger and somehow become even more profitable per car.
That loops right back to that positive feedback loop we discussed earlier. The operational theory is that at 3 million units a year, their logistics network would be so dense and so efficient that their transport cost per unit would essentially bottom out. Plus, they would be buying so many cars directly from consumers that they would effectively set the floor price for the whole market.
But is that actually realistic? I mean, scaling operations on paper is easy, but in reality, it's brutal. Where are they going to find 3 million used cars to buy every year? They can't just manufacture them.
That is undeniably the biggest challenge they face. They have to source that inventory directly from customers.
Right.
That means they need 3 million individual people every year to say, I'll just sell my car to Carvana on my phone instead of trading it in at the local Honda dealer. That requires a massive, permanent shift in mainstream consumer behavior. But if you look at the 5 million transactions they've already completed, the behavior is clearly shifting.
It really feels like the Amazon moment for cars. I remember back in the day when people said, sure, I will buy a paperback book online, but I will never buy clothes online. I need to physically try them on. And now Amazon packages with shoes and coats show up at my door every other day.
It is a very similar adoption trajectory. First, the consensus was, I will never buy a car unseen. Then it evolved to, okay, maybe I'll do it if they have a really good 7-day no questions asked return policy. And now, for 600,000 people this past year, it is just the normal default way to buy a vehicle.
So let's wrap this up with a big takeaway for everyone listening. We have thrown a ton of numbers around today. Billions in profit, deferred tax assets, unit economics, EBITDA margins. If I am just a regular person interested in business and e-commerce, what is the ultimate headline story here?
The headline is that the grand experiment is officially over. Carvana is no longer a risky test case for online car sales. With over $20 billion in revenue and a very stable multi-billion-dollar operating income, they have definitively proven that their unit economics work at scale. All that physical infrastructure they spent billions of years building, the Odessa sites, the custom logistics network, it's finally paying massive dividends.
And we can confidently say the profit isn't just an accounting mirage.
The tax assets absolutely inflated the final net income number, yes, but that $1.88 billion in GAAP operating income proves the underlying cash machine is very real.
Here's the final thought I want to leave you with, and it is a bit of a provocation to chew on. Ernie Garcia noted in the letter that they are still, quote, very small relative to our opportunity. If they actually pull this off, if they go from 600,000 cars to 3 million cars a year, what does your local town look like in 2030?
That is the existential question for the industry.
Because right now, every single town in America has a strip of car dealerships. You know the ones. Giant American flags waving, huge lots, just full of depreciating inventory. If one giant tech company can offer a better price, a seamless 7-day return policy, and drop the car off in your driveway, and they can do it way more profitably than the guy down the street, does the guy down the street even survive the decade?
It puts incredible crushing pressure on the traditional franchise model. The local dealer has massive overhead, expensive floor plan interest for their inventory, and strict geographic limitations. Carvana has a national pricing algorithm. It is incredibly hard to compete with an algorithm that is backed by $2 billion in annual profit.
We really might be looking at the extinction of the let me go talk to my manager era of buying cars.
And honestly, I really don't think many consumers would mourn that loss.
I certainly wouldn't. I'd miss the free stale popcorn, maybe. But that is about it.
Even the popcorn is a toss-up on a good day.
Very true. Well, we will have to see if they can actually hit those aggressive 2026 targets. But for now, Carvana is very definitively in the driver's seat. Thanks for diving in with us today.
Always a pleasure.